Hello traders, Gary Wagner here for Trending Markets. Approximately 10:30 in Honolulu, 4:30 in New York, Thursday the 20th day of August, and a day that we will remember as a brutal sell-off occurred in the U.S. equities markets. Globally, in fact, markets have been down, but when we look at the Dow Jones Industrial Average, that is off about 2%, a little bit over 2% on the day, but off 358 points below 17,000, 16,990.69. You can see this tremendous sell-off when we look at our daily chart here. Just an incredible move to the downside. The question is, where will the carnage stop? And we've got a couple of bottoms, but we've actually gone and exceeded them on this close today. You can see that quite clearly when we line up these two last lows that we've seen. We know that we had the rounded top. We talked about that. And then we talked about the fact that what many traders look at, and we'll pull up the chart in a second, is that long-term moving average, 200-day moving average in the S&P. Now, this has just been a brutal day as we saw this market come down, categorically lower pricing, but I want to take a look at the S&Ps off 48 points, 2024 off 2.32%, and I draw your attention to the chart we're going to enlarge right now, and that's this chart. This single line right in here is our 200-day moving average, roughly. And so we talked about the fact yesterday that we had this close, came in below it. Again, we're looking at a daily chart, standard candlestick format. We talked about the fact that if we had that kind of a close, we could see this market go dramatically lower. And in fact, we saw just that, this market literally falling out of bed, trading off more than 2%. The real question is what is going to halt this sell-off in the equities markets? How will that affect other markets? Of course, oil really plays into the picture. That's our only active position, although I did get emails from a couple of our subscribers to Trending Markets that listened to what I had to say about the S&Ps and they went and shorted it. Excellent call for those that emailed me, and I hope there's others out there that did the same. Whether or not you email me is not important. Whether you make profit to me is extremely important, obviously. So we see this market trading dramatically lower. When we look on a technical basis, we've exceeded some key levels here, primarily this 2040 right in here. And that's just based on the fact that we had these bottoms before, right in here. The next real level, if we look at it, doesn't come in till about 1980. That's a considerable ways away. I don't think the market's going to fall that much. But the only real levels that I can define, and this is, I'm hard-pressed to define this at 2020 because I'm only looking at a couple of days of activity in which it was a supportive level. This is really a lot of noise right in here in terms of finding realistic support and resistance levels, and so we're going to have to see how this plays out tomorrow. But I will tell you, this has probably shaken up many investors in the market today, and we have seen, really, we had 2 days prior to this where we had lower prices, but not dramatic in the way that we saw today. Now, as I talked about, the one position that we are in is crude oil. We are short, I believe, at 41.87. Market is up just a little bit today, almost a percent, about 34 cents on the day. So it is back over 41. I do believe that it still has that opportunity really to break below 40 and to go to the 37, 38 area. That's what I'm looking for initially. When we look at our daily chart, let's go ahead and blow this up. There's obviously, we have a bias to the downside. I mean, that's obvious. You don't have to be a rocket scientist for that. But when we look at our channel lines, we've been trading really within the mid-range. You can see a number of up days such as today, here, these small green candles, but they are very short-lived. You get alternating candle colors with the majority of them obviously being down days. Now, that changes when we convert this to a Japanese average chart. And the reason for that is that rather than using a true open or true close as in the case of a candlestick chart, a standard candlestick chart, when we look at a Japanese average chart, the open is the midpoint of the prior day. So we're simply looking at where the market trades, what the midpoint of that prior day is. We're looking at a daily chart, and then that becomes the open. As long as it trades and closes below that midpoint, is colored in red. If you get any kind of a tail to the upside of the candle, such as you get here or here, here or here, what that is telling you is that at some point it did trade above the midpoint of the day, but the fact that it closed below the midpoint, which is where the open is fixed, is the reason it stays red. Now, when we do that, what you see is a different picture than a candlestick chart, because you don't really get the alternating colors that you get then. And we're still really in the midpoint of this cascading downward channel line, but nonetheless, the bias is to the downside. Today's candle, although we saw it up slightly when you compare it to the midpoint of yesterday's trading activity, it never traded above the midpoint. You see that there's no upper wick, and that is a pretty strong sign, because it's telling you that it could not actually go above the midpoint at any point during the day. And the size of the candle relative to these other ones is about the same. You're not getting these very, very large candles like you got here. Neither are you getting these consolidating candles like you got here. So in my opinion, based on the fundamentals at play, as well as the technicals that we're looking at, I do believe we will see lower oil prices. This has been Gary Wagner for Trending Markets. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.